Hey, this is Value After Hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Special guest today is Tim Travis, TT Capital Management. He's a value investing specialist. We've had him on lots of times. Great to see you again, Tim. How are you?
Oh, I'm doing well. Thanks for having me, guys. Always a fun time being on the show.
Welcome back.
So one little update. Since we saw you last, you've become SEC registered. You've got out of California. Congrats.
Yeah, it's a different ball game from a regulatory standpoint, but it's signals growth, so happy about that for sure. Thank you.
How are you seeing the investment landscape at the moment? We've had a pretty good run over the last 12 months. Things looking a little bit toppy, expensive. What do you think?
Oh,
I
leading the
certainly,
witness.
Am I leading?
yeah,
Objection,
yeah,
objection.
I certainly think so. It's interesting. Valuations are at some of the highest levels since 2000, and you look at where interest rates are, and it's interesting because the Fed cuts 50 basis points, then another 25 basis points, but all bond yields did was go up, right?
Yeah.
Yeah, what's that
It
about?
so a lot of worry about perhaps inflation creeping back, and what does that mean for the housing market? I don't know if you guys have looked at mortgage rates or anything like that, but it's absolutely brutal. I mean, for first-time home buyers, they're really struggling right now. And so for me, I think that it's a good time to be relatively cautious with your investments. Take advantage of the high yields that are out there.
It's an interesting move that the that rates have taken since they've cut rates twice, and it looks like they've the market's completely ignored that. I wasn't aware that the market was allowed to do that.
Yeah,
What do you make of that?
yeah. Who's smarter, the wisdom of the crowds or the PhDs at the Mariner Eccles building?
Who knows? It's an interesting dilemma. It definitely puts the Fed in one because the rate cuts did not have the intended effect. Long-term rates are rallying, and I think the expectation really was that, okay, once we get to the election, and I think probably the expectation was most likely Harris would win. Not the betting markets towards the end, but maybe at one point a couple months ago, that maybe the economy would go into kind of a recession after that. We've had so much spending. People are kind of skeptical about the unemployment numbers, and so okay, if we have a recession, well, lower rates are likely. But now I think there's a lot more optimism in the economy, and in the business principles that are going to be, yeah, extolled, I guess you want to say, and that's having, pressure on rates. So it's an interesting dilemma. It's one where I think you just want to be fluid. You don't want to make too big of a bet either direction. Bond ladders, that sort of thing. Focus on valuations. A lot of people are just getting a little too aggressive, in my opinion. A lot of the portfolios we review, they're just almost 100% stocks for like a 70-year-old, and it's just not appropriate for a lot of people.
What allocation do you recommend they make to Bitcoin? Because
Risk on, baby. That's the answer.
risk on.
Whenever anyone says Bitcoin, I just say, like, look, scratch that itch a little bit, because the worst thing you could do is not scratch that itch, and then it doubles or does something crazy, and then I've seen people literally put their whole retirement into it. And it works sometimes, but then sometimes they can't handle the volatility. Or I've also heard of people that had their wallets stolen and stuff like that. So, like anything, if you scratch that itch a little bit and in moderation, I think it can be reasonable.
And
Bitcoin's at
are the base
88,000.
rates for that 60% of the time it works every time?
I guess so.
Bitcoin's at 88,500 right now. And there's a Scottie Pippen, I think it was Pippen, tweeted out that, and this is in like June, he said he had a dream where he was told that Bitcoin would be 84,000 on November 5th.
Oh, get out of
And
here.
I saw
yeah,
that. That's
he's
incredible.
he's we gotta figure out what's going on in Scottie
Oh,
Pippen's dreams.
Nostradamus there with
laser eyes.
Yeah,
hopefully he capitalized. I'm sure he did.
yeah, he's had a pretty good run.
Yeah.
Um, you've been on previously, we've talked about financials, but just I know you're not entirely focused on financials, but I'm just wondering because it's financials are sensitive to rates particularly, and they are sensitive to the business cycle. And so I think it's been a little bit hard to tease out because it looks to me like the private sector's been quite weak and it's been papered over by a whole lot of government spending. And rates, I have no idea what rates are doing. The Fed's cutting, rates look like they're running up. And then we've got this yield curve inversion, and it looked like it was sort of undoing a little bit, but and I think that's more real in the other two occasions where it sort of looked like it's normalizing because it's the front end that's been coming down most quickly. But I think that there's a very complex backdrop for banks at the moment. So I just sort of wanted your take on what you think's going on,
I
how you think
agree.
banks are.
Yeah, there's a lot of different revenue streams there. So if you look at kind of the big banks, they've got kind of the investment banking side, and then they've got kind of the net interest margin type spread side. And so, at a certain point, rate hikes help, and at a certain point, it doesn't help, as we saw kind of in the March 2023 banking crisis, if you want to call it that. I liked being on when that was going on because I thought it was very overblown. And
Yeah, good
so
call.
thank you. And
Yeah.
so, we saw a few rate cuts, and the banks responded by lowering some of their deposit costs, the CD costs. And so net interest margins are kind of expected to kind of be fairly stable, but net interest income might decline a little bit is kind of the expectation. What's really important is credit and then lending growth. So I think the expectation was with rates going down, you'd see more lending, but now on the long end, it really, hasn't materialized as much as I think people expected. But you also have more optimism in the economy. So I've been reading a lot of like private equity earnings calls and some of the bank earnings calls, and they do seem pretty optimistic about the deal pipeline. So I think that like business is good for them. I think they'll do well. And then you get into the individual situations like Wells Fargo's an interesting growth story. They might get some relief on some of the regulatory measures that have been brought against them. Citigroup is in perpetual turnaround mode, and they might be nearing an inflection
Since
point.
1998.
Yeah, but then you look at valuations, guys, and they're looking a little stretched on a lot of them. I mean, it's interesting that, where JP Morgan's trading and Buffett's selling Bank of America, another really well-run bank, but it does look a little pricey here to where I wouldn't necessarily want to own it. So yeah, I think you just have to be, valuation specific. Some offer pretty good value. Some of the European ones, like BNP Paribas, is a really good bank in Europe, for instance. And it's trading at like 7.5, 7 times earnings. It yields like 7.5%. It's got a return on tangible common equity of about 11%, and it's very consistent. It's a well-run quality bank. Credit is really not a big issue for them across a variety of cycles. So something like that, you're probably going to do pretty well over the long term with, especially with that dividend. But I'd be wary about some of the high flyers here.
What are the high flyers? Like what do you include in that group?
I mean, I'd say like the thing with banks and what a horrendous utilization of like the last 15 years to be so interested in banks, to be honest with you, because it's like, the worst regulatory environment ever for them. But the thing with banks is that if the economy or the stock market catches a cold, they have the bubonic plague, right? I mean, they just get absolutely murdered. And then in any situation, it's like, okay, well, your stock's getting killed and there's uncertainty. So let's stop buybacks. Let's stop share buybacks
Right.
because we got to conserve capital for the regulatory, agencies and stuff like that. So they're not able to capitalize on some of the opportunities that other companies can. So yeah, I think just stuff that's trading at a big discount to tangible book that still earns a decent ROTCE and that you feel good about credit with. Citigroup I think is still reasonable, and I like BNP a lot.
In other areas, we were talking about REITs a little bit before we came on. Do you want to give us your thoughts
Yeah.
on REITs?
Yeah, so REITs have been a successful investment for us. With the high interest rate environment, a lot of these real estate investment trusts and real estate related companies, they saw their stocks decline by 50%, 40%, 60%. And valuations got quite interesting with dividend yields between 5 to even 8% on high quality names that should be growing their dividends just about every year. Most years they should. And you can look at kind of the refinance risk. That's one of the areas of uncertainty. How much debt do you have to refinance over the next year or two? And then when interest rates started going down, they had big runs. A lot of these ran 40, 50%. And now with the interest rate volatility kind of picking back up, some of these stocks are selling off a little bit again. And so you can lock in a 6% or even a 7% dividend that is likely to grow, and you're paying maybe, 2/3 of the normalized valuation on some of these. And so for investors that are reasonably conservative, are worried that the market might be in a little bit of a bubble, if there is a bubble and we get a recession, interest rates might go down, that's going to be really good for some of these REITs. So I do think there's opportunity there.
I think one of the guys from Marathon, who are famous for their capital cycle theory work, said, I think I don't know, I don't know if he said commercial specifically, but that basically the bottom was in for
Yeah.
the operations for a lot of these things that have been facing problems the last couple of years.
Yeah, I mean, if you separate like office is kind of its own world. And even those stocks, if you look at them, if you look at like Vornado or SL Green or whatever that one's called, in New York SLG, if you look at them, the stocks have actually done quite well lately. So they've definitely bottomed. But I still don't want to play in that space. But like the net lease area is really interesting. Cell towers, I think there's opportunity. So like a few of the ones we like Crown Castle. That one's trading just above 100. It's got a dividend yield of about 6%. That was a $200 stock not that long ago. And there was a headwind from the Sprint merger. And so there was some redundancy in the towers. And so they lost a little bit of their revenue there. But long term, they should grow double digits organically. And you've already got a 6% dividend that looks reasonably safe, barring if they like divest a portion of their business, which is a potential outcome. And yeah, something like that, or Vici Properties, the casino owner and entertainment property owner, that pays about 5.5% and still trades at a pretty low valuation. They have 100% occupancy, 100% rental payments even during COVID. And then another one we like is WP Carey. They are a triple net lease operator in America and Europe, and they divested their offices, and that was controversial. It reduced earnings in the short term and reduced the dividend, and it wasn't well forecasted to investors. So a lot of investors got burnt. They hate it. And so now it's like, all right, well, all these people hate it. And if you just look at it now, it's a lot cleaner company trading at a really low valuation for the quality of its assets. And it pays, I believe, a 7.5% dividend, somewhere around there.
Do you follow what's going on in office at all? Is
Yeah.
that you think that's turning around, or you think the
No.
stock is turning?
No, I don't. I just
No.
think like anything, it just gets priced to oblivion, and
Yeah,
then I mean
yeah.
the big money people, like the really big, like I saw an article in the Wall Street Journal today that some of like the old family money in New York, they're finally selling some of their stuff. But if you have really deep pockets and you can convert some of these things to like condos or really upgrade the amenities, or I mean, if you think more nefariously, let's say you have connections in politics that might change an area like San Francisco, and I mean, think of what you could do there if you just have a little bit of better policy out there with how cheap those assets are in San Francisco. I wouldn't be surprised to see a renaissance, but you got to have deep pockets and political connections.
Yeah, I think San Francisco turns it around eventually. It has to get really bombed out first. It has to get really, really cheap. And some of those office buildings have been trading for just like it's just jaw dropping
Yeah,
the
one
discounts
dollar,
that some of
take
those
the
have
debt.
taken.
Would you
Yeah.
park would you park your car out there up there?
No, but I mean, at some point you can hold that. You could sit in that office. You could sit in that
No,
building
for
for a little
sure.
while.
I
But
agree. I would if I had that type of capital and
yeah,
connections, I think that would be one of the great turnaround potential opportunities out there.
Mm.
I mean, I think that tech rises again, but tech hasn't fallen over yet. So when
Right.
tech falls over, maybe it rises again. Let me do a quick shout out to the folks at home. Brown Mariboso. It's hard to say. Toronto. Santo Domingo, Dominican Republic. What's up? Boise, Idaho. Bendigo, Victoria. Good effort, Hamish. Early start for you. Moncton, New Brunswick, Canada. Another in Toronto. Bellevue. Savonlinna, Finland. Good for you. You're a regular. Tallahassee, Edinburgh. Scotland, Kennesaw, Georgia. Madeira Island, Portugal. Winning. Somerville, New Jersey. Thornhill, Ontario, Chicago, Cromwell, New Zealand, another early start. William the Wizard of Waterloo in Waterloo, London. Bogota, Lausanne, Switzerland, another regular. Some,
It's a good spread.
It's impressive, eclectic.
It's so hard to scroll on this thing. Here we go. I'll get everybody. Sook, British Columbia, Brooklyn, good.
Maybe we don't have to
Good
do
job,
all of
fellas. I insist. Tim, one of the things that we were talking about, Buffett has been selling Wells Fargo for quite a while. So Wells Fargo has idiosyncratic problems that he's been selling. But I was a little bit surprised to see him punch out of so much Apple. If you read some of his comments before then, it did sound like this is one of his permanent holdings. And evidently he's just, I don't know, trimmed because it's run too much or something like that. But he's been selling.
It's a little more than a trim. That's
a close shave.
Yeah, I was gonna say that's like Tim went in for a haircut and got that.
Yes. Barber doesn't cost me a lot of money nowadays, thankfully. But yeah, I mean, you look at the valuation. Like Charlie Bilello had a tweet maybe yesterday or 2 days ago where he talked about Apple's valuation, and all the metrics were like 50% higher than historical averages, and the growth rates really aren't there to justify that. I mean, we'd all agree it's an absolutely amazing business with incredible and competitive advantages that are likely to stay for quite some time. But so it's interesting. So I think from a valuation standpoint, that's probably a big part of it. And then I think you guys would probably agree there's also some level where he's thinking about how he wants to leave that company for the next CEO. And if you have such a big stake in Apple, that's a huge amount of pressure, right? Because if you sell, oh, this idiot sold, and missed out on these billions of profits. And if you don't sell, it's like, oh my gosh, Buffett would have sold. It's like,
you're
it's no
spineless.
win.
You
Yeah.
don't make your own decisions. Kind of
Yeah.
a no win for Greg, right?
It really is. Or exactly. Is Greg going to be managing the core investments or?
I think, I mean, I think Todd and Ted are primarily doing that, but I think Greg sort of has final say on just about everything. So I'm not sure exactly what something like Apple would look like there.
Yeah.
You don't know whose book that counts towards, whether it's his or whether it's the.
Yeah, not sure exactly where that would fall. It's an
So
interesting
you think
question.
the selling is more about it's like a setting it up for the next guy rather than.
I think it's probably like 50-50 to some extent. I mean, I do think he's looking at it as like, okay, I've made so much money off this, and the valuation is really extreme. I mean, he got burnt holding Coca-Cola for too long. He's definitely sensitive to valuations, and he knows that if he were to say, okay, look, the stock market's in a bubble, that's going to piss off a lot of people, including honestly like politicians. It's like, all right, well, this guy's trying to cause like a bear market. He doesn't want that responsibility, but he shut down the partnership in 1969. 2000, he did the Sun Valley speech, or was it 1999? Whatever. When he did the Sun Valley speech talking about the tech bubble. So you can kind of see how he feels about the market by his actions, and aggressively selling Apple, aggressively selling Bank of America. So yeah, I think it's probably 50-50.
One thing I think is interesting is around 2007, he was pretty bullish. Like you can find a lot of comments from him at that time where he wasn't publicly bearish. And a lot of people said, well, that's because he's transitioned from like he's now a steward of the entire financial system. He sort of got too big where he can't shit talk the valuations anymore. And he's probably, I don't know, have you seen any comments from him recently? Has he made any comments about the level of the market?
I haven't heard much. How about you, Jake?
No, but he definitely talked in 21 about, relative. And last year he did say like he thinks that this is the most gambling kind of
Mm.
ethos that he's seen, which really says something. I mean, that's a lot of years of market history to filter through that prism, and to find this period as the most gambly is, yeah, that says something.
I I thought there was a lot of gamble in the market, but I haven't been looking at it for that long. But I did see 2000. There's a lot of gamble in 2000 too. I don't know if there's more gamble now, maybe because there's so many other ways that you can gamble, including on
Quite easy.
elections.
Yeah, quite
Yeah.
easy.
That was it. That I don't want to get political because I don't want to turn off half of the listeners or 100% of our listeners, but
Yeah.
I don't want to lose 6 or 12. But the poly market, I was kind of interested in that. I was following that and some of the other prediction markets against the polling. And it's funny how there, I don't know how long out from it. It was like a month or a few weeks out. Poly market wildly diverged. The two chances, like Trump ran up and Kamala ran down. And that seemed to be true across all of the markets. And there was some people were attributing that um, to some sort of whale coming in and like moving those markets. But it seems like the prediction markets got it right. Like, and JT talked about this a little because I was looking at Kamala. Kamala was at 33%. So you get 3 for 1 in a 2 horse race. I mean, Kelly would tell you to put some capital to
Put
work
a
there.
little on.
I get the logic for sure, on that. And I bet on the prior election and it didn't work out too well for me. So I was kind of worried that
Reticent.
this one might be a little fortified. But I think yeah, I mean it was quite I mean a huge blowout really. So it would have been tough to fortify it much, I think.
Yeah, it's interesting that the election markets seem to be the prediction markets seem to be more accurate than the polls, like quite a bit more.
Polls were really bad again. It's amazing that they were wrong every single time, but I
Why
mean
do we even bother?
the best is like Nate Silver. He's so shameless. It's like, looking back, uh, this is the most likely outcome. Like,
Well, I think like that like ray gun from the Olympics. The enduring like meme from this Olympics is Nate Silver on election day. He said, I've run 80,000 simulations. And I think he said Kamala wins in like 40,006 and
Oh,
Trump
gee.
wins in like just so it's like basically a coin toss. But he was giving it to Kamala on that base, but didn't work.
glad to see you give a shout out to Ray Gun, Australia's finest on display.
It's such a shame. There's so many great moments from that. The only good thing that's come out of it, though, it's like there's been some great Halloween costumes
Yeah. Like
and
name one Australian swimmer, the women's who like they crushed, right? You can't, but you know Reagan.
Yeah.
she's parlayed it into millions, I'm sure.
Legend.
Um, JT, do you want to do your veggies a little early and then we'll
Sure. They
circle
might
back?
not be cooked all the way, but okay. We could serve them up.
I've got to tell you guys that the reason I laughed halfway through that last bit, Les Winan has jumped on and he says he's in prominent of Australia. It's good to see you moving around, Les. That's not a
Well,
real place, ladies and gentlemen.
no. We've got
Maybe it is. I don't know.
a little Australia for you today. So,
Oh, good.
today's segment is on animal tales, and this is not like Five Going West. That's
DuckTales.
not where not we're talking DuckTales. Um, this is the various tales in nature, and then torturing those into investment analogies. And a quick shout out to John Chu for sending me the initial inspiration on this. The first one we're going to look at is nature's incredible athlete of the cheetah. And we all know it's the fastest land animal, reaching speeds of up to 60 miles an hour. But the speed alone isn't what makes the cheetah such a great hunter. It's actually about the agility that the cheetah has. And so imagine if you're going 60 miles an hour in a straight line, and then all of a sudden you just make a 90-degree turn, super sharp without, falling over and crashing into a million, tumbles. But how do they do that? And the answer is it's the cheetah has a remarkable tail, which allows it to balance itself out. It's like this high-speed counterweight. And when it changes direction instantly, that it acts like a stabilizer so that it can stay balanced and pivot without losing control. So taking some inspiration for that for our portfolios, the cheetah's tail helps it stay balanced. And a portfolio tail is a collection of perhaps smaller, agile positions that give you as an investor the flexibility and balance like a cheetah. And rather than being overly concentrated in just a few large names, like, I don't know, maybe you're a hippo, a tail of companies allows you to hold small stakes in a basket of various companies. And so you could make quick moves without losing balance. And, a lot of times investors feel pressure to make these big all-in decisions and place large bets on a few big picks, right? And that's, Munger's been extolling that, as long as we've been around to, really bet, why put money into your fourth best idea? And that's fair, and especially actually if you manage money professionally and you have large LPs who use you as a sleeve for other investments, and you're just a small portion for them, and they're getting diversification across a bunch of different managers. There could be pressure on you then to really push into your best ideas because that's what they want, right? They want the highest octane version of you, not some sensible basket. Even though that might not be best for you from a career risk perspective or even, psychologically. So that super concentration can lead to over-attachment to any one given name. And when you have a lot riding on just a few, it can be harder to be objective and your emotions can really cloud your judgment. So this portfolio tail offers a counterbalance to that, like the cheetah's tail. And these smaller, you can explore, new ideas without perhaps having so much stress on you. And if you're not forced to immediately decide if a company deserves all of your capital, you can kind of dip a toe in the water and get more familiar with the company. And it's really hard to know a company until you've actually owned it for a little while. I don't know if you guys feel the same way. And I actually have I have a friend who he'll use like deep out of the money call options to build a basket of names that he's interested in. And then this allows him to explore more companies without committing even less capital. It's kind of like, it's actually reminds me of NVR's approach to the way that they do property acquisition.
Like a land bank.
Right. So if one of those ideas doesn't pan out, not a big deal. You haven't overcommitted. But if one shows a lot of promise, you have capital left to then scale it up. And in essence, this strategy really captures the speed and adaptability of the cheetah with a portfolio tail. So I don't know, TC or Tim, does this remind you at all of how you guys manage money at all?
Yeah, I mean, absolutely. We've taken pretty concentrated stakes and lived
What's concentrated for you?
Like 10% positions or even higher, but then also within an industry. So you might have a couple of those. So we did that when the odds are just stacked in our favor, and when we really can't find a way that we'll lose over the long term. We've kind of done that. The thing that I've learned in the industry, though, so we started this company 13 years ago, been in the industry 20 years now, and what I'd be comfortable with from a volatility standpoint or like a hedge fund type manager standpoint is not a level of volatility that many clients would be comfortable with. And so I found that it doesn't do you any good to try to like maximize performance if that performance comes with way too much volatility where the client is not comfortable and they don't benefit from it. So we've kind of gotten less concentrated over time. We'd still be open to it if it was just, a perfect pitch in our strike zone. But yeah, I think you've got to keep in mind your investors and what they're what they're comfortable with, really.
Yeah,
Toby, you do more even position sizing.
I vastly prefer spreading the bets a little bit more. Just because there's so much idiosyncratic risk in I've worked in a public company. I was general counsel of a public company, and I used to talk to the analysts on the outside, and I just thought it was crazy how much of a disconnect there was between what I saw was going on and what they thought was going on. You can probably like getting some of that distance is probably a good thing sometimes because maybe you can see things that people who are too close can't see. So it's not just a one-way street, but I think that there are just a lot of ways to lose in this business. And I think that if you have some edge, if you have some ability to find things that are undervalued, then the more you can let that edge express itself that's not tied to one business, the better you'll do over the long term. But I can't find fault with Charlie's argument about, your fourth best idea. I don't really know what the answer to that is other than diversification, variation is in and of itself a good thing.
I think Berkowitz learned that too the hard way. I mean, Berkowitz was amazing. He is an amazing investor, and he had so many wins over his career and concentrated bets, really concentrated, gutsy picks. And but so many people look at him and define him from Sears Holdings, and that was just such a tough one. There was a lot of opportunity. There was a lot of logic in that thesis, but it seemed like Eddie Lampert kind of got too attached to the retail business, and it's hard. It's hard. You're running a huge company. You don't want to just lay off tens of thousands of employees. It's a hard game when you get into the restructuring. But
Do you think that? So when you said Berkowitz, I immediately thought of St. Joe's. I thought St. Joe's was
it's a
his,
monster, yeah.
but that's right. I forgot he was very big in
Huge.
Sears as well.
And Fannie and Freddie too burned him.
Yeah, yeah, yeah. That's a problem.
Those were logical bets too, really
Yeah,
logical bets. It's hard sometimes. I think of Puerto Rico, Assured Guarantee. That's a company I invested in for a long time. I know you invested in it for
yeah.
a little bit, Toby, and they reported earnings today. They were really strong, but the situation in Puerto Rico was so bizarre because you had this electric utility, which is a monopoly, and they really had liquidity issues and just huge corruption, huge fraud where people are on the payrolls, but they're not showing up to work. The most egregious stuff you could imagine.
Like
So
they work out port.
it should have been a really easy restructuring. Like, okay, inject it with a little liquidity, and put some capital in there, but put more efficiency controls, that sort of thing. But it's been going on for 10 years. They still haven't restructured this one credit. It's been 10 years since all the drama started, and it's like something that seems so easy, but it's hard to tell political ramifications. That's kind of why I'm a little more sour on the banks than I used to. It's like it's just not a fun business to be in with all the regulatory risk that's out there.
Just looking
All
at
right,
AGI, it's had a good run.
It's had a great run, and I mean what's crazy if you look at the book value per share growth of that company, it rivals just about any insurance company you'll find. And I was thinking about it with what you said, Toby. It there is danger in like being too close to a company, but it is nice when you know how a CEO will respond to adversity. So I remember during COVID and the lockdowns, that stock just plummeted, man. I mean, like a lot of them did. But I think one day it was like it went from like 32 to like 13, something like that. And it was like, what was the news? There really wasn't any. There wasn't any really news specific. And the good thing about that CEO, Dominic Federico, is that he's gonna buy back his stock. Like he's gonna
Yeah,
take advantage of the massive discount. So you're gonna see a huge growth in the per share metrics. And that gives you a big degree of confidence. It's amazing seeing it play out. And he's had longevity too. I mean, he's been with that company since they IPO'd, I believe, in 2003.
it's a good advertisement for smart buybacks,
Yeah.
AGI. They
They
can really,
are. Yeah. And it doesn't get any, you don't hear about them. Like nobody
yeah.
really talks about them.
And if you look at it, then it just gets scarier. Like the moment you start taking a look at it, it insures muni bonds, and when you, and that always looks like a scary. Anytime it pops up in the news, it's because it's associated with some bankruptcy
Yeah.
somewhere. So it's never getting good news. It's only ever the crises that attract attention.
It is. I saw today. So their below investment grade exposure was at the lowest level it had ever been in. And then today they added, I believe it was 10 billion. I haven't gone through everything yet. I believe they added like almost 10 billion. And it was these water companies in the UK. So like the Thames Water Company, they're having some kind of liquidity issues. It's a monopoly company. In a good government, UK is generally pretty business friendly, or at least they were. So it'll probably work out fine. Like I don't think they're actually going to lose any money on it, especially when you factor in the premiums they've collected on it. But it's like, okay, well now there's such big numbers you're throwing out there. Like, oh, well, it's a $5 billion exposure, right? So exactly, it's just always headline risk. So we're not as big there as we used to be. We just have kind of like a small position left, but I would definitely buy it if it went down. I was hoping it would go down actually.
What's the book value per share?
Oh
It's
man.
sitting at
The
there.
the the adjusted one is like over 160 now. And then the operating one is like 111.
Mm.
So just fantastic growth. For you watching, if you're interested in stock buybacks done well, look at that company. Look what they've done and look at how, the returns on equity aren't great or anything like that. It's not a great business overall, but it's been run well.
We
It
have
was in.
more tail stuff if you guys want to.
Oh yeah, sorry, JC. I didn't
Yeah,
catch you off there.
no worries. So if we're gonna get a little closer to home for Toby, and this is the old kangaroo tail, and I don't know,
Oh,
is it
well,
true, Toby, that you have to fight a kangaroo to be considered a man in Australia?
that's the traditional method. Yeah.
Okay, good. All right, so they're famous for their hopping and covering 25 feet in a single bound. I don't know if have you ever seen that before?
Uh, I've seen them. I've seen them I've seen them in herds, like racing across the. I don't know if I couldn't tell you how big the leaps are. They're pretty big.
Okay.
Kangaroo. The bucks are pretty big. Could
Well,
be.
there's something that makes those big hops possible, and it's their tail. And they use it. They even call it like their fifth leg for support and balance. Although I'm not sure, do they have hands or leg, or
Yeah.
is it all
Yeah. They
four
got
legs?
paws. They got little paws. They got paws. Yeah.
Yeah. Okay. So without that big tail, they'd be much more prone to stumbling, falling over as they were hopping. So this concept of stability in the tail might be akin to like tail risk hedging. And in this instance, when the terrain gets tough for the kangaroo, similarly, when the terrain gets tough in markets, tail risk hedge can help your portfolio weather a very turbulent market conditions without losing your footing. So, imagine a market downturn. I know it's hard to imagine because we don't do those anymore, but the tail, is this safe haven assets that can help stabilize the portfolio. So people use different instruments for this: put options, government bonds, gold, certain volatility strategies, and they all act as this kind of support system that helps the portfolio hop over rough patches without losing balance. Um, the next tail we'll get to is like the scorpion's tail, and it's multifunctional tool. As you know, it has this venomous stinger on the end of it that lets it both play defense and offense. So it can protect itself from threats, but it can also hunt and secure food with its tail. So think about the tail risk hedging in some instances, the way it's done. During a downturn, you get this big you get the defense of the protected, shield from losses, but then also, perhaps just as importantly, you get fresh capital that you can then use to deploy and go on offense. And it's quite a bit easier to have fresh capital as opposed to having to sell something that was suddenly trading. It was at 10 times earnings and now it's at 5 times earnings, and you're selling it in order to buy something at 3 times earnings. That can be very difficult to do psychologically. But to have fresh capital instead, and then you can go buy that thing at 3 times earnings, that's a lot easier to execute. So the scorpion's tail embodies the same idea of kind of protection and opportunity together, that they don't have to be mutually exclusive. And then the last
It,
one.
it's a
Go
good
ahead.
psychological. I think it's a good psychological. The tail hedge is a good psychological hedge there as well. I mean, I think it's really only effective if you can take the money and put it long again, and which you can't really do if it's in a fund. Sorry to all my vol fund buddies, but if the money's in a fund, like the money doesn't get paid out, or you can't redeem it quickly enough. Whereas if you've executed it through some sort of option or something else like that, the money comes back to you and you can then stick it long again.
Right.
That's all I had to say.
The last one we'll look at are lizards, and many lizards, they use their tail for balance, obviously, but they also have this extra survival trick where they can shed their tail if they're threatened. I'm curious if that hurts or not. But so imagine a predator grabs a hold of a lizard's tail and it can actually break off and let the lizard escape and survive. And for investors, then this shedding ability is similar to liquidating a small flexible position within your portfolio when there's need for liquidity. And so you maintain this diverse tail of smaller adaptable investments that can then you could shed certain positions when needed, when free up resources without really disturbing the core holdings. And this approach lets the main portfolio kind of stay safe without and still allows you to also react quickly when something better comes along. So just to summarize, all these animals have been using tails for their advantage in a lot of different ways, and it's possible that we could think about how we craft our tails in the investment world to draw inspiration from that.
I like that. Good one. Could be non-recourse debt as well. Like if you've got a margin loan and you got some path dependency on the position, you can't shed it. Whereas if you've got if it's not tied to the position, maybe you can hold on to it a little bit longer.
Mm.
Or real estate. I mean, so many of those companies are giving up office buildings and walking away, but it doesn't jeopardize the overall business.
Yeah, good one.
It's hard. I don't know. Whenever I buy puts as like a hedge or something like that, which isn't very likely, or maybe I'll have a client that kind of requests it. It's hard mentally for me just because I know the
To cross
clock's
the
running
spread.
against me. I
Oh,
I I like
okay.
I mean I sell options, and
Yeah.
so buying the put mentally for me is challenging. I kind of do the tail hedging with bonds more or less, and then if rates do decline, it's easier now in this yield environment. It was so hard. I didn't touch bonds for 15 years really, but now there's a lot you can do.
So you buy like a government bond, a 10-year or something like that, with the
Buy
idea that
that
if it
investment grade
gets
bonds, yeah.
yeah, if it
Some of
gets
yeah.
gnarly and they drop rates, you get a rally in the bonds. So you got some counterballast.
Ideally, although that didn't happen in 22,
Right.
it went the other way.
The
Yeah,
starting base
yeah.
rate's important,
You
and
lost on
having kind
both.
of a bond ladder helps for sure.
I mean, it's just to return to where we were at the start. If the Fed cutting rates isn't really impacting the bond market, or isn't, I'm not sure what rate we're talking about when we're talking about it rallying, but the mortgage rate certainly is. Mortgages are as expensive now as they have been at any point in time.
Based on the 10-year, the mortgage is based on the 10-year. So yeah, it's a scary time to look at a home because you have affordability as bad as it's ever been, and then you have the financing costs. So it's brutal. And I mean, I think that's part of what you saw in election. People are if you don't own a home, not only have you missed out on all this appreciation, but it's really hard to get into one. So it's a huge wealth gap from that.
They don't resolve quickly either. Those affordability crises, they take years and years and years to sort out.
You
Because
just
house
have to
prices,
grow into it.
yeah, they don't really collapse. I mean, I know that was like that's what everybody thought before 2006. So that's not
Yeah.
entirely true
They
anymore. But it
just go
used to
up
be
and
that
to the right,
they just go
3% a year.
sideways. When I was studying it, that was what they used to say: don't overcapitalize your house because don't make too many improvements because you never get the money back out. Like house prices don't go up. That's
Yeah.
how long ago it was.
But even then,
Oh,
like,
yeah.
let's say you did buy a house opportunistically, you've done well on it. Like, unless you're relevering it, which,
Mhm.
kind of dividend recapping your house, who cares? Like, it's just equity that's sitting there that you're like your cost of living, doesn't
Yeah,
like you're basically just tying up a bunch of equity at a low rate of return on it. It's like, okay, what am I accomplishing here exactly?
the dividend recap doesn't help you much either because it's tied to your income. So your income has to have given you a little bit more breathing room too.
Right.
I mean, if you didn't buy one though, I mean, like I remember we bought our house in 2018, and it's doubled, and we've put some money into it too though. But so now if we were, I mean, it's a lot of equity that we've built up to it. So if we bought a new home, we could use that equity and probably not even have any mortgage whatsoever. So, but if you didn't buy a home, you've been renting the whole time, and prices have just gone up, and they keep raising your rents. It's just really hard. You still have to have the enough for the down payment, and the financing costs are so high. It's brutal. I mean, especially in California, as you guys know. I mean, easily make six figures and not be able to afford a home.
I saw a good chart of California the other day, which had this little green line up against the beach, which was, unaffordable paradise, and then every other part of it was like red or something like that. It was like affordable hellscape or something like that.
Yeah.
Meth.
Right.
Yeah, I mean, it's not that far off, is it? It is rather, people would probably be surprised to know, uh, once you get out of the main city centers of California, like up in the mountains, it looks a little bit more like Appalachia than than you might think. Trust me, because that's where
Sure.
I grew up, and it gets a little redneck up there.
Um, just this is we'll go a little bit macro, but what do
Oh,
you
good.
what do you think about yeah, we haven't done that for a little bit. What's your I mean, we're all Buffett's selling. There's not a lot of interesting stuff. I
What
don't
does
think
it
there's
all mean, Tim?
yeah, some that's basically where I'm going. What's the vibe?
I think it's just look, this is the time that taxes you psychologically. It's easy to think like, okay, maybe you're more optimistic because of the election, whatever. You're more optimistic because of the economy somehow. And it's easy to kind of stray and maybe be a little more aggressive than you should. And then something happens that changes the dynamic. Like 2020, it was COVID, right? And the lockdowns. And so I just think you want to be smart. Like you can make 7, 8% in investment grade bonds right now and have very little risk. To me, that's a good risk reward, especially after already having a really good rally. Park a little bit of money there to where if the market sells off and gives you real bargains again, you have ammo and you're not having to sell stocks that are already down a lot. So I think it's just a time you have to think long term. I mean, the long term returns from here over the next decade are not likely to be great, but who knows over the next year? And that's what you're battling against.
Yeah. What about the rally in Carvana? Did anybody pick up some Carvana on the way through? Have you watched that one,
Boy,
Tim?
you're down 99%, and now I think you're 70x from the bottom.
Yeah, 750% in
Whew.
2024.
It's insane. That was one. It's always the highly levered ones
Yeah.
where I remember I looked at the bonds on that and I thought that the bonds might be an interesting play because the technology platform is, you can see the benefits of it. But yeah, it's one of those where it could easily have gone bankrupt. It easily could have.
Yeah. Yeah. That's what I thought too. That without commenting on the management team, but it did seem like the it had some bankruptcy risk there.
Hmm.
Has that gone away now completely? Is that why we're back to the races? It's a technology company again.
I mean, if they're smart, I'm sure they've done equity offerings. I haven't
Yeah.
been following it close enough, but that would be the smart move for sure.
Yeah,
That's like what AMC did. What AMC did was actually pretty smart. I
turn
mean, that
thin
was a
air into
horrendous
cash.
balance. Yeah, that was a horrendous balance sheet with, I mean, what happened with the lockdowns in the movie industry business is unprecedented. And they were smart. Issue equity, transition rig. I believe I mentioned the bonds the last time I was on the show, and I think they were yielding around 10%, maybe a little lower. But like those have had a nice rally, and they've done a similar thing where they've issued a little bit of stock, fixed the balance sheet. There's a good underlying business, just a bad balance sheet. Now there's talk they might merge with Seadrill, which has a good balance sheet but not as many rigs. So we'll see what happens there. But same principles.
I mean,
What?
Sailor might
Yeah.
be the king of this right now with issuing equity on a company and then turning around and buying Bitcoin with it, levering up on top of that,
Unbelievable.
and then just keep pushing that up, issue more. Like it's
I mean, that's
working.
that strategy. There's no universe in which that strategy doesn't work. It just continues to work forever, that one.
Oh man.
This is like Hunt Brothers meets oh, I don't know what. This is pretty wild.
Can
Put
you
the
call?
not investment advice disclosure on that.
Yeah.
Yeah, be careful, please.
Yes.
I was going to mention MicroStrategy. I just thought
But it
because they've
might
just
work.
done 2 billion at the market and then plowed it straight into Bitcoin, and Bitcoin's immediately rallied. Like either because I don't know how deep that market is, either because he's bought into it or because who knows. There's
Yeah.
there's whatever way the election went, there was going to be a whole lot of money printing probably going on afterwards. So
True.
that's probably how that's
I went
why
and
that's
I
happened.
watched the earnings uh presentation that they did this last quarter, and because had a pretty good, like, I don't know, he talked for maybe 45 minutes or something, and he just went through how they think about everything. It's it's quite
You take
interesting. Like,
45 minutes. Oh,
I
there's
know, well, he's got some slides, and like if Bitcoin keeps going up and to the right, like this is going to work really well.
Yeah.
If it doesn't,
but
like
that's one slide. So
that's the one Jenga piece that if you pull that
ah,
out, the whole thing kind of collapses. But who knows? I mean, it's not like governments are super chaste and
yeah.
everyone's clamoring for austerity around the world. So shit, man, who knows? Maybe that does work.
What's everybody think about Apple here? Does Apple, because Apple's sort of been flattish over the last little while. Is Buffett selling because it's like just so nosebleed expensive? I mean, I know other than what
I
we've
think
discussed
so.
earlier.
I
Yeah.
think so. The valuation's crazy, really. I mean, it's a lot of them, but that's the market right now. You look at Costco, you look at Apple, it's a very pricey, expensive market where there's not a lot of margin of safety in there. So yeah, I mean, I think that I don't think it's particularly attractive.
I mean, are these like bond yields or bond proxies at this point, basically? Like there's such everyone believes in these companies so much that they're willing to look at that stream of cash flow as being money good effectively as almost as good as the government's ability to repay. Um, or maybe they're more like tips, really. That might be the more reasonable interpretation.
That's amazing though, because you have AI. So you have like this mechanism which is going to cause so much disruption. And
But
it's weird.
not to $1.50 hot dogs.
Yeah, right. That's true. And it's weird that like the assumption is just that the
They're gonna
winners
win.
are the ones that won before pretty much, except for Intel. It's interesting how that works.
It seems that the cost of it is just like, was it Sam Altman? Or what's his name? The Japanese,
Most of your son.
yeah, it was his
Yes.
son. Was it Masa's son who came out and
Yeah.
said like $9 trillion, this problem's solved? I was like, 9 trillion.
Like we were gonna get like AGI with $9 trillion spent.
Something like that. Like he just said it. He was just like, yes, I'm raising a $9 trillion fund or something like that. That's
Oh man.
not crazy enough, Massa.
Where
Being
are we
a-
on that chart? Like, are we down at the bottom where it's right at the inflection and it's gonna
What
go up
did we
to the
print?
unicorn?
What did we print during 2020 though, with all the stimulus? It was several trillion dollars just here, right?
Yeah, I think it
So,
was what did we run? Like 2 or 3 trillion deficit in that.
yeah,
I mean, we're at a one and a half now, like continually, even in the greatest economy ever.
right.
It's
Unbelievable.
impressive.
yeah, it does feel a little bit frothy.
Deficits, yeah, it's hard. It's a hard think of you're coming in, honestly, like into this economy. It's pretty challenging. Like you have interest rates where they're at, where they're not likely to be able to go down much further. You have very low unemployment that looks to be inflated by the government numbers. It would not be surprised to see more and more revisions like we've already seen all year.
It's just
It's
been
got,
government jobs that have been growing. Is
Yeah.
that kind of the takeaway?
yeah, I
Plus
don't
a lot of
know.
stimmy through the Inflation Reduction Act and other things like that. If you
Yeah.
pull that stimmy out, what does that look like? Like gnarly, I think.
That's what I've thought the whole time. And I mean all the like the credit related companies, it's like they did a good job kind of documenting, okay, well, our average saver has 3 times as much money in their checking account with like $4,000 instead of like 1,200 or something like that. And now a lot of that's kind of gone.
What is
And
that,
and
like
there's
2 months worth of rent? I mean,
Right. I mean, yeah. I mean, look at the dollar stores. I mean, like Dollar General. I think that stock was at like 300 or something crazy like that, and now it's at below 80. And they even say it's like, okay, the first 3 weeks of the month are okay, but then once our average consumer, runs out of their money, then they stop spending, and it just has a massive impact.
totally anecdotal and N of one. And this could be chalked up to the $20 minimum wage thing that went through in California. But I have a 16-year-old who's looking for a first job kind of thing and having a really hard time finding anything. Like, just no, not you can apply, but they're not hiring.
Do Chick-fil-A. I think they like give the or like they allow the workers that are there for a while to buy the franchise for super cheap. And yeah, I would definitely be doing that if I was a kid. Those things print money.
Problem is he's got very limited hours because of baseball commitments and school. So it's like,
Yeah.
yeah, Chick-fil-A is a little bit too serious of a job, I think.
It's hard to reconcile the Fed cutting given all the, Bitcoin at 90,000 bucks, stock markets at all-time highs, unaffordability issues with real property. I mean, would you cut into this environment? Unemployment's basically at all-time lows.
I don't have a PhD in economics, so sorry, can't help you.
But even the PhDs should be, isn't the playbook that this is I mean, if you're a Keynesian PhD, which they all are, neo-Keynesian PhD, that would say you would be recommending raising rates in this environment, wouldn't you?
You can't take the punch bowl away.
Well, you
I
can't
don't
take
see
the
how you
punch
do
bowl away
anything.
ever.
I
You're gonna
really
get-
don't see how you do
You
anything.
get
I
fired
was
if you do that.
the last 25 basis points, I didn't really get either. It's just kind of, it seemed like superfluous at that point. But I would just sit and watch and see what's going to happen. None of us have any real idea what's gonna happen. There's just so much. You have high valuations, high rates. We'll see what happens with these unemployment numbers. But until you get a recession, it's tough to see rates really coming down to levels where people were expecting them to be.
Do you
Maybe
think
maybe there's actually quite a bit of deflation on the come if China tips over even further. And that's a lot of commodity inflation that's existed the last 20 years as they poured all the concrete that's been poured in the 21st century and a million other stats on how much natural resources they
into
used.
their ghost cities.
Probably see some steel tariffs, even more, which could be an interesting dynamic to watch.
So tariffs are probably inflationary. And, you know, there's an argument that inflation is a little bit harder to put back in the bottle once it starts. That, you know,
Well, look at the unions like pushing 40% pay increase into their contracts. Like that becomes structural at some point, right?
Yeah.
Well,
That's a big,
if the war in Ukraine ends, if that ends, which I think is likely, finally, that could have some interesting impacts because a lot of the commodity markets were really altered dramatically by that, at least over the short term. So, and then during Trump's last administration, it was drill baby drill, and I think oil for most of it was below $75 because there were, drilling and it was very open. So that could be deflationary if energy prices, stay relatively low. So it's going to be an interesting dichotomy. I wouldn't want to prognosticate that. It's just stay disciplined to what you can understand and don't get lost in the macro would be my advice.
It's quite an interesting counterfactual to imagine that we didn't discover fracking and like that never happened. And what the price of oil was 150 or 200 for the last decade instead of, and like US wasn't exporting natural gas. We were importing still all these things that like pre that we were pretty heavily reliant on external sources for energy. I mean, that's that could be like the equivalent of the Fed funds rate being like 7 or 8 or 10 or something with a $200 oil. Like what would the economy look like if we didn't have we hadn't found that bailout, cheat code fracking.
Good point. I mean, I wonder if Munger never really changed his opinion or publicly about not drilling any of our oil, only relying on others.
I mean, that's smart
save it for future generations.
Not from a financial perspective, but from like a security perspective, which is one of the reasons for the tariffs to try and bring some heavy production back home. But there's a cost to that, which is you pay more for the things that you produce here. I would like last time Trump came in, small value let like, Rupert when Michael Caine told him he was going to get the genital cuff, like it took off like a rocket. So I would like to see. Yeah. I would like to see a little bit of that this time around. And it did seem that like on the day of that, did like 5% or something.
Yeah, Russell was excited.
Yeah. But I think all of that stuff is pretty short term. It's just not like it's all I consult the almanac. The almanac said that we're always weak into the election, and then from election to inauguration, it's pretty strong. That's stock market's already at all-time highs. Like run a little bit, and then what happens? Then you've got
to face all these problems. And
yeah, by any measure, price to book, price to sales, Schiller, like we're bumping right up against the top of as expensive as we've been. Having said that, Japan went to 100 times, China went to 100 times. You're a piker at 37 times, going to 40 times. You can go 2.5 times over that.
Toby, where we're going, we don't need valuations.
We haven't needed them for a long time. Yeah. Tim, we're coming up on time. Any last words?
Not really. You can find me at ttvalueinvesting.com is my website. We have a newsletter you can sign up for. And my Twitter handle is Tim Travis Value.
I think Tim's advice about being, conservative, don't get too caught up in the price action recently, which can often, desensitize you to the risks that can be out there. So just tread lightly, I would say.
Yeah.
As Tim said.
Sage words. JT, any developments at your end?
No, just happy to be home for a couple weeks before back on the road. Sleep in my own bed. That's my favorite.
All right, folks. Thanks so much for joining us today. See you next